Okay, thank you very much for the opportunity to present this paper here. So this is joint work with Stephen Ongena and Alex Popov, and the usual disclaimer applies since Alex is at the ECB and I'm at the Nederlandsche Bank. So the paper is entitled The Invisible Hand of the Government, Moral Suasion During the European Sovereign Debt Crisis. So this paper is really about the special relationship between banks and sovereigns, and this relationship has been long-standing. So to give you two historical examples, already in 433 before Christ, the Temple of Athena loaned money to the state of Athens at a 6% interest. This was a rather generous agreement as it charged up to 30% rates on loans to merchants and shipmasters. In 1688, the government granted a monopoly charter to the Bank of England in exchange for a series of loans. And in the words of Calomeres and Haber, this is an early example of a partnership between the government and a group of bankers. So, while there is a partnership between governments and bankers, governments do face inherent conflicts of interest with respect to this partnership. And perhaps the most important one is that they regulate banks, yet at the same time, they look to them as a source of finance. And as a result, the question has been asked whether governments might prompt banks to provide them with financing in terms of need. It's something called moral suasion. And this idea gained prominence during the European sovereign debt crisis. And the reason is because there have been several developments in the sovereign debt market that suggest that something like moral suasion might be going on. So the first thing is that if you here look at the monthly holdings of domestic sovereign debt of euro area banks, you see that these holdings more than doubled since October 2008. And if you look at the blue line, which is the holdings of foreign sovereign debt, you see that they stayed almost stable. If we then split between the sovereign debt holdings of banks in stressed versus non-stressed countries, then you see that this increase in domestic sovereign debt is specifically due to actions taken by banks in Greece, Ireland, Italy, Portugal, and Spain. And then if you dig even further, then you see that after March 2010, this increase is really driven by domestic banks, while foreign banks active in these countries are actually reducing their holdings of domestic sovereign debt. So there has been ample speculation that moral suasion actually takes place. Jeff Cox in May 2012 wrote an article called Time Bomb, Banks' Pressure to Buy Government Debt. Also, Viral Acharya says in a Fox EU article that sovereign credit risk may alter swiftly as it did in 2008-2009 due to, among others, moral suasion of the financial sector. Jens Weidmann says that reasons for the increased exposure of banks to their domestic sovereigns may include moral suasion, and there could be moral suasion by regulators or politicians in Greece to support the efforts of the authorities to effectively stay in the Eurozone, according to Alex Michailidis in Economic Policy. So what is moral suasion? Moral suasion can be defined as the appeal to morality or patriotic duty to induce profit non-maximizing behavior, and this is possibly combined with the threat of a more repressive regime. For example, discontinuing access to the Fed's discount window, revoking a bank's license, intensifying supervision. However, it could also entail collusion or collaboration between two parties. So, this idea of moral suasion is not new. This is a leaflet that was used in the First World War in order to moral suade the public to buy government debt. Also in the Second World War, this was used here where people are swayed to buy war saving stamps. But there are also other examples of moral suasion. So if you don't want to ride with Hitler, you have to join a car sharing club. So there have been quite some empirical evidence that is consistent with the occurrence of moral suasion during the sovereign debt crisis. However, there is still no smoke and gun, and the reasons are because it takes place in the shadows. It's hard to identify moral suasion. But also there are many confounding factors that can explain why specifically domestic banks had a higher demand for domestic sovereign debt. Some of the reasons that have been put forward in the literature is risk shifting, banks buying sovereign debt in order to tie their to tie whether they are going to fail to the government. Regulatory compliance, the increase in sovereign debt holdings in order to raise their capital ratio, and carry trading. So what we're going to do here, we're going to set a decisive step towards identifying moral suasion. So we're going to exploit three important characteristics of sovereign bond markets. So one is that the amount of maturing debt is the main determinant of newly issued debt. For example, in Italy in 2012, 360 billion euro debt was maturing and 365 billion was auctioned. The amount of maturing debt is exogenously determined. If you look at, for example, the Monti government in April 2012, 100% of this maturing debt was issued by predecessors. So 2/3 was issued by the Berlusconi government and 1/3 was issued by the Prodi government. And as a result of this government's need to refinance maturing debt varies between months. So newly issued debt, both the combination of rollover debt and additional funding needs, fluctuates wildly month on month. This happens in tranquil times, but also importantly, this happens in crisis times as well. So if you look at this graph, this is the amount auctioned for Italy over the course of the sovereign debt crisis. And you see that there are huge differences. In November 2011, the government placed 11 billion new debt, while in March 2012, it placed over 35 billion new debt. So what our identification is going to rest on is exploiting these monthly fluctuations. So the idea is that if governments of fiscally stressed countries need to morally sway their banks, this should specifically happen in those months where this issuance is high. And we're going to differentiate between what we call high need and low need months. And in our main analysis, we just do the cutoff at the median, but we also show robustness when we do different cutoffs. So this is what we are basically going to do. This is the amount that are auctioned every month in Italy. We take the median cutoff, and then we are comparing the purchases of banks in high need months versus in low need months. So the second step in our identification is that some banks are more likely to be morally swayed than others. And the most obvious difference, if you look at bank characteristics, is that some banks are domestic owned and some banks are foreign owned. So you would expect that domestic banks are more vulnerable to moral suasion because they're more vulnerable to explicit and implicit threats if they decide not to cooperate. At the same time, domestic banks have more to lose if an auction fails in terms of funding costs, because their funding costs are very closely linked to the spread of the sovereign. So what we're going to do is we take the sovereign debt crisis period, because there is only need for moral suasion when sovereigns are in distress, and we compare the purchases by domestic versus foreign banks active in stressed countries, and compare them between high need and low need months. If there are large differences between domestic and foreign banks in high need months, this is consistent with the occurrence of moral suasion. So the important beneficial part of our identification strategy is that it uses this monthly frequency. And this high frequency comparison allows us to include bank fixed effects, which reduces concerns that we are capturing any alternative mechanisms that can explain why domestic banks buy more sovereign debt during a crisis period. Things like risk shifting, regulatory compliance, or carry trading. So as long as this is uncorrelated with government need, all these other reasons should be picked up by the bank fixed effects. So any remaining concerns we address formally by controlling for the change in bank regulatory capital, bank risk, bond yields, and liquidity. We also do a number of falsification tests. We look at foreign sovereign debt, global financial crisis, and what happened in Germany. And we dig deeper and look at some different characteristics of domestic banks. So what do we find? Domestic banks are more likely to purchase domestic sovereign debt in months when the government faces a high refinancing need. And this holds when we control for both bank fixed effects, country times month fixed effects, recapitalization, and other monthly balance sheet shocks. This evidence indicates that governments indeed morally sway domestic banks in times of fiscal stress. And we find that this effect is particularly strong for state-owned and supported banks with low initial stock of domestic sovereign debt, which suggests that there might be some strategic suasion going on. So how does our paper contribute to the literature? Well, there is a very active literature currently looking at the sovereign bank nexus, banks' incentives to hold domestic sovereign debt and its impact on the real economy. There's a number of theoretical papers and a number of empirical papers. Our paper specifically adds to the literature that looks at to what extent moral suasion was driving the increase in banks' holdings of sovereign debt. And where we differ between all the other papers is that we look at actual bond holdings, monthly data, and our identification that's based on governments' refinancing needs during the crisis period. Finally, our paper relates to the large literature on politicians and banks, where we look at the political determinants of security holdings. So which are the data that we use? So we have access to proprietary ECB data. These are bank-level monthly data from the ECB's individual balance sheet statistics, also called IPSI. And these are monthly observations for 247 banks from August 2007 onwards. We use 60 banks in Greece, Ireland, Italy, Portugal, and Spain. And importantly, the data has information on both the flow and the monthly stock of domestic sovereign debt securities. We have also, it enables us to use a number of monthly controls, assets, deposits, loans, and capital. Importantly, we have to differentiate between foreign and domestic banks. So we use the bank ownership database that Stijn Claessens and I prepared. And we have in our data 13 foreign versus 47 domestic banks. And the domestic banks can be state-owned or privately owned. Importantly, there are foreign and domestic banks in each of our country active. The sovereign debt data are monthly data on bond auctions from Bloomberg. And we also use monthly data on maturing debt from the centralized securities database from the ECB. For our crisis period, we use the activation and deactivation of the SMP program. That means that for Greece, Ireland, and Portugal, our sample period is May 2010 to September 2012. And for Italy and Spain, it's August 2011 to September 2012. So our empirical model, I hope you can read it. So it's domestic sovereign debt is defined as the net purchase of domestic sovereign debt relative to the stock of domestic sovereign debt in the previous month by Bank I from country J in year month T. High need is a dummy that is one if the government faces above median refinancing need in year month T. Domestic is a dummy if the bank is domestic owned. Then we have a number of time varying bank-specific control variables, size, funding source, and the capital ratio. And we include, as I said, bank fixed effects and country times year-month fixed effects. So our main coefficient of interest is beta 1, and it captures the difference between domestic and foreign banks in the propensity to buy domestic sovereign debt in high-need months compared to low-need months. So first, let's have a quick look at some summary statistics of the domestic versus foreign banks in the pre-crisis period. So the first something that is quite clear comes out of the data is that there is no difference in the holdings of domestic sovereign debt between domestic and foreign banks prior to the crisis. So what we see in the graph that I showed before is really something that was driven by something in the crisis. If we then look at some of the observable bank characteristics, we see that domestic banks are larger and that domestic banks are better capitalized, which should assuage some risk shifting or regulatory compliance concerns. But we're going to address that more formally later on. So if we look at the auction debt, then we see that there is substantial variation in the auction debt within each country. So in each country, during this crisis period, we see really some spikes and some lows in how much debt is auctioned. The coefficient of variation varies from 1.8 in Greece to 4 in Italy. The only exception is Ireland, where the coefficient of variation is relatively low because Ireland was cut off from international bond markets for a period during the sample period. However, if we exclude Ireland, then that does not affect our results. So this is our main table. So what if we, first what we see is that, as we already could see clearly from the graphs, is that domestic banks exhibit a persistently higher appetite for domestic sovereign bonds during the sovereign debt crisis. So all of these regressions are purely over the sample period that picks the time when the sovereign debt crisis was most severe. So domestic banks exhibit a persistently higher appetite for domestic sovereign bonds, but importantly, domestic banks are more likely to purchase domestic sovereign bonds in these high need months. So in these months where the government needs to issue a relatively large amount of new debt. And this effect is robust to bank fixed effects, country times, time dummies, and a number of balance sheet controls. So if you think about the economic significance, during high need months, domestic banks increased their holdings of domestic sovereign debt by almost half of the within sample standard deviation. So this is our main finding. So the next is we're going to do a lot of robustness tests to make sure that what we really pick up of this is moral suasion and not something else. So the first thing that we want to do is look at model robustness. And the first step is to replace auction debt with maturing debt. The idea being that with the newly issued debt, there is an endogenous component there because the government can still choose to issue a bit more in certain months. And that might be correlated with banks' demand for domestic banks' demand for domestic sovereign debt. The maturing debt, that's purely exogenous because that's already predetermined by previous governments. So if we replace our high need dummy based on auction debt with the high need dummy based on maturing debt, we still find the same result. It's also not surprising because, as I said before, the vast majority of the newly issued debt is rolling over of maturing debt. And the correlation between maturing and auction debt is also very high, it's 0.77. We also look at a more extreme cutoff, 75% versus 25%. And the results are robust to that. And we also look at the continuous variable of auction debt instead of differentiating between these high need and low need months. And we also find our results to still be significant. So we do a whole bunch of other robustness tests. We look at different dependent variables, the change in flows and the change in stocks. We exclude, as I said, Ireland, but we also exclude Greece because in some months Greece was also cut out from the sovereign bond market. We exclude the 2 months in which the VLTRO took place, and the results are also not driven by that. We use a difference in differences model in which we use our complete sample period for which these IPSI data are available. That's September 2007 to June 2013, and then use a triple interaction. And then we find again that the difference between purchases of domestic sovereign debt between domestic and foreign banks is especially strong in the high need months when specifically the sovereign is stressed. If we look at these high need months when the sovereign is not stressed, then this difference does not play up. We finally use a matched sample of domestic and foreign banks because, as I showed before, they're not completely the same set of banks if you look at pre-crisis observables. So we do a propensity score matching procedure, and that also doesn't change our result. So the main benefit of our identification, our month-on-month identification, is that it allows us to control for unobservable and observable time-invariant bank characteristics, observable time-varying bank characteristics, and unobservable and observable time-varying and country characteristics. However, there could still be lingering concerns that domestic banks are facing shocks in high-need months that affect their demand for domestic sovereign bonds that foreign banks are not facing. So what we're next going to do is to control for these possible confounding factors, so these monthly things that happen monthly. So the first thing is that we interact all the monthly bank characteristics, all these balance sheet characteristics that we have on a monthly basis as well, to allow them to differ for domestic banks. And we see that the results are not affected by this. The next step is that we control for monthly changes in the riskiness of the bank and the riskiness of the sovereign. The idea being that if a bank has an incentive to shift risk and therefore buy domestic sovereign debt, it will most likely do that when it itself is most risky or when the sovereign is most risky. So when we control for monthly changes in the riskiness of the bank and the riskiness of the sovereign, that still does not affect our results. And it's also not the case that the riskiness of the sovereign, the spread of the sovereign, is correlated with months that the government has to auction a relatively large amount of debt. So that's also not explaining our results. Then there could be the idea that especially because the government has some flexibility in deciding how much it auctions each month, it is possible that it's exactly auctioning a larger amount when domestic banks are facing a deposit windfall that could drive our results, or it's possible that the demand for loans in the economy is much lower in certain months, and that's affecting domestic banks more than foreign banks because domestic banks are more exposed to the domestic market. And therefore, if this correlates with these high need months, then the banks will have a reason to buy sovereign debt in those months because demand for real loans is low, not because moral suasion of the government. But if we control for the interest rate, then the spread on the interest rate spread for each bank, then we also don't find that affects our results. Then there can be the idea that the results might be driven by domestic primary dealers that act on behalf of non-eligible banks. Well, we looked at all the primary dealers in the market, and it turns out that most of these primary dealers are actually large global banks and are not the local domestic banks. But even so, we control for the primary dealers and differentiate how they behave during high need versus low need months. And we still find that the domestic banks have a higher purchase of domestic sovereign debt during high need months compared to foreign banks. Finally, you could also argue that maybe it's moral suasion on behalf of the home government of the foreign banks that drives the result. This is rather unlikely because it would imply that, for example, the French government is swaying the subsidiary of Société Générale in Spain to reduce its holdings of Spanish sovereign debt exactly at the moment that the Spanish government needs to issue a relatively large amount of debt. So it's quite far-fetched. But still, we look at the difference between foreign banks' purchase of domestic sovereign debt, so the sovereign debt of the country in which they are located, and between high need and low need months, and we see that there is no difference in the behavior of these foreign banks. So it's really driven by the differential behavior of the domestic banks. So finally, we do a number of falsification tests. So the first two look at test whether this is really something that's driven by the purchase of domestic sovereign bonds. And indeed, we find no differential impact on the purchase of foreign sovereign debt or loans to the government. So it's really about banks purchasing domestic sovereign bonds in months when the market demand is low, but the government needs to issue a large amount of new debt. And finally, we do two placebo tests. So one is we look at for the same set of countries and differentiating between high and need months, but now during the global financial crisis. So banks were in trouble, but the sovereign was not. And there you see there is no different behavior of domestic versus sovereign banks. We also find during the sovereign debt crisis, we don't find a different behavior between domestic and foreign banks in Germany. Germany, there was no problem in the market of sovereign debt. There was ample demand. And there you don't see that domestic banks in Germany are increasing their holdings of German sovereign debt, specifically in the months where Germany has to issue a larger amount of debt. So it's really something that's driven by a stressed period, a period where the sovereign is stressed, where market demand is low, and where the government, for mostly predetermined reasons, has to issue a large amount of debt. And that's then picked up by the domestic banks. So as a final thing, we look at what type of domestic banks are more likely to actually engage in this behavior. And we find that within the sample of domestic banks, it's banks that with low initial holdings of sovereign bonds, and specifically those that are state-owned or receive government support during the financial crisis. So this could point out that there is some kind of informed suasion where the government kind of knows which banks are most able to pick up this new additional debt. So to conclude, domestic banks, we find that domestic banks are more likely than foreign banks to purchase domestic sovereign debt in high need months during periods of elevated sovereign risk. And this is independent of regulatory compliance, risk shifting, carry trading, and shocks to liquidity and investment opportunities. And we find that the effect is stronger for state-owned and supported banks with low initial holdings of domestic sovereign bonds. And the results suggest that indeed governments morally sway banks in times of fiscal stress. The policy implications, so what it shows is that there is some type of collusion of sovereigns and banks during times of fiscal stress, which can help stabilize the system. So domestic banks seem to act as a lender of last resort, and this is especially beneficial when markets are overreacting, specifically when there are self-confirming expectations. However, it does reinforce the link between banks and sovereigns when sovereign bond spreads are already high, and this suggests that some changes in regulation are necessary. The first step, of course, which has already been done, is to reduce the chance that banks need to be bailed out by the government. The banking union with common supervision and resolution is a decisive step towards that, and also the higher capital ratios plus the introduction of the liquidity ratio. However, that still does not help that there is a specific relationship between the banks and the sovereigns. So the sovereign debt has a special regulatory treatment. However, to increase the resilience of shocks to sovereign debt, some people have suggested that some changes should be taking place here as well. One is the introduction of the leverage ratio, also to introduce positive risk weights on sovereign debt, which recognizes that sovereign debt is not risk-free, or to introduce exposure limits also to sovereign debt holdings, which does not apply to sovereign debt now, but does apply to all other asset classes. Thank you very much.